is Market Moves.
Hello, thanks for joining us on Market Moves. Today's star performer on the 200, Virgin Blue. It rose 12.5%. The day's worst performer, Kadeku, which fell by 16%. Joining us to tell us what was moving those markets, what he thinks of the direction of the markets, Roger Montgomery from rogermontgomery.com and author.
After he stops being silly off camera.
I should have introduced you as market expert and author as well, shouldn't I?
Thank you very much.
There you go. Congratulations on the book.
Thank you.
Now, let's just talk about the market.
This is it, by the way, just in case anybody... Yeah, there it is.
Because, of course, you haven't shown it on this program yet.
No, just all the others.
Yes. All right, well, let's just have a look at the market. And we have reason to smile today because we were up. And what do you think? I mean, were we following gains on Shanghai, or was it the slight rally on Wall Street or local
My
earnings?
answer's always the same to that question. You know that. And it's probably a little bit boring. I don't pay any attention to short-term moves unless we go and ask all the people who bought and sold shares today why they did it. We're never going to find out really why it went up or down. And I really think investors would be better served if they think about the individual businesses that we're going to be talking about today and what they're really worth, as opposed to short-term price changes. Everyone seems to be focused on price changes, and obviously because they're changing all the time, they're interesting. But really, I'm looking at values, not prices.
Given that our market does follow the US though quite closely, sure. And there did seem to be this suggestion overnight that the US stocks rallied because people were beginning to see, well, hang on, look, they're looking very cheap. I mean, do you follow that market at all closely?
Yeah, I look at US companies and I watch the US market, and I'm interested in what's happening over there, particularly interested in whether or not the economy is recovering or not, or whether there's going to be a double dip, and so I'm interested in all of that kind of commentary. I don't try and forecast it myself, and I don't really care whether or not people say that it's going to go into a recession or whether it's going to recover. I'm more interested in the individual businesses and how they're performing in that environment.
Woolies lifted full year net profit by 10% to just over $2 billion. The balance sheet is looking in better shape than a year ago, to the tune of around $760 million. Woolies has announced $700 million of that will be used to undertake an off-market share buyback. Love this news today, but what do you think of Woolworths?
Finally, the market's actually acting sensibly. You know, a month ago or a month and a half ago, 6 weeks ago, I was talking about the big switch from Woolworths into Wesfarmers, because Wesfarmers is, there's a turnaround story going on in Coles and everybody's enamoured with the whole turnaround and they don't want to miss out. But Woolies is a superior business to the Wesfarmers conglomerate in terms of its return on equity and in terms of its performance, its intrinsic value performance over a decade. And I think it was 4 weeks ago, at the end of last month, Woolies was trading around $25. And I vaguely remember saying that that's about its intrinsic value. It was a little bit higher than that at the time, so it was a small discount. Well, now the market's finally catching up, and we've got a situation where the stock is now a little bit ahead of its intrinsic value, but reflecting the performance of the business. I'm not surprised about the buyback, but I do recall that there was an article in one of the financial newspapers maybe a month ago saying that a buyback indicates that they don't have any growth prospects, and that helped to push the share price down. I think that there was a lot of negative sentiment around Woolies. It looks like this result is turning that sentiment around. And I'm no good at predicting sentiment, but what I can tell you is that the value of this business has been going up for a long time, and it will continue to go up over the next couple of years. The buyback will only do more to increase the intrinsic value of the company.
Right, so around $27.54.
Well, they're buying. Well, if you think about it, if you can't find something else to buy that's cheap, and you are cheap, you should buy yourself. Yeah. Warren Buffett did exactly this. Gave the same advice to Coca-Cola many, many years ago, and he suggested that when he bought the stock, he suggested to the board of Coke that they should buy back shares. Not his, of course. He'll keep his, but they'll buy back shares. Now, investors need to be very careful. They need to make a decision about this, because in order to get the buyback over the line, the company will give various incentives related to the franking credit. So there'll be a small, it might be I think it's $3 or something they're proposing. That'll be the capital return, and the rest will be a fully franked dividend. So a lot of people will see that as a great opportunity. My advice. Well, it's not advice, of course, but my suggestion would be that the business will be worth more after the buyback. So if you're going to get some advice on this, the advice you'd want to get is whether or not it's appropriate to actually sell your shares into the buyback and then buy shares back on market and take advantage of that franked dividend.
Let's just turn to another result today, Fortescue. Looking at Fortescue, $4.50 today, up 3.7% there. Is this close at all to the intrinsic value?
The intrinsic value is higher than the current price, as it is for BHP. But a caveat, it's based on some fairly optimistic assumptions about the iron ore price. There are some very smart people globally who believe that the property bubble and the infrastructure spending that's driven GDP growth in China is not sustainable, and if that is the case, then we'll see demand for raw materials wind back. And in fact, the Chinese banks, as you know, the government has been imposing all sorts of restrictions on their LVRs. They're going to have to bring a whole bunch of liabilities back onto their balance sheets. That's why we've seen Chinese bank share prices drop over the last 6 months or thereabouts, and so it's already happening, if you like. There's a scaling back of lending for these kinds of projects, and that will ultimately translate, I think, into lower prices for iron ore. Now, I'm not forecasting the iron ore price, but that just seems like a logical thing to expect. If that happens, then my intrinsic values will drop, as will the share prices for BHP and Fortescue. Again, it's those worries that I have that I really can't put my finger on that prevent me from buying a whole bunch of shares in these companies.
TOL, another one of those stocks doing well, just closing below $6 there, up about 2.7%. What do you think of this one?
TOL is a business whose return on equity for several years now has been relatively mediocre. So, I'm looking at some numbers here. For 2008, return on equity 8.83%, 2009 11%, this year about 11% again. They're not particularly exciting returns on equity, and as a share investor, as an investor in businesses through the share market, you have this awesome choice. You get to choose which businesses you want to invest in. Now, you can try scaling 13-foot hurdles and hope that businesses with mediocre returns on equity are going to start improving, or you can actually find the 1-foot hurdles where there are already very high rates of return on equity with a demonstrated track record of earning power, and that's likely to continue. I'd rather be invested in those sorts of businesses. TOL, just to give everybody a heads up about its intrinsic value, I've got an intrinsic value of TOL of about $4.40. And its share price, as you know, is significantly higher than that. Yeah. I'm really interested in today's price move in Virgin. You mentioned It was the highest performing, strongest performing stock. Miracles never cease to amaze me. This is a business that you really do need to put into perspective. Its share price, 7 years ago or thereabouts, was about I think it listed at $2 or thereabouts.
Yeah. And today it's 30 cents or something.
Exactly.
Like that. Yeah.
So you're looking at a business. Yes, it's gone up 10%. It's gone up 3 cents or thereabouts. But the big picture is the picture you should look at, because over long periods of time, share prices tend to follow the performance of the underlying business. And airlines aren't great businesses. Now, Borghetti, who's running that business, he may be a championship rower. He may be the best rower of a business there is, but airlines are boats that are perpetually leaking. And it doesn't matter who's rowing those businesses, you really can't change their economics dramatically.
But smart move, tying up with Etihad? I mean, flights into Abu Dhabi, I mean...
Yeah, sure. There's smart moves going on in the airline space all the time, and they continue to lose money. If you listen to the peak body for international airlines, they're going to lose something like $5.5 billion in total this year, and in the last 10 years they've lost $50 billion or $55 billion. Airlines just don't make money. The economics are all wrong. There needs to be fewer airlines. They need to charge $1,000 to fly to Melbourne, and it needs to be luxury form of travel again. That's the only way they'll make money.